Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, April 12th, 2024. It's 9:44 a.m. Eastern Time as I'm starting the video, and just figured I'd get one out early. Let's follow up with the just kind of the big things that highlighted yesterday, the financials, especially the king. Again, this is the 800-pound gorilla. Like I said, this is what NVDA is to the stock market, to tech, to AI. This is to banking. Make no mistake about that. So we'll go over the earnings, and so far the charts were again, as they often are, the accurate predictor of where a stock's going to go post earnings. Day's not over, but you're down, 4%. If they gobble this up and turn it green, I would be very surprised. So take it for what it's worth. And more importantly, remember, it just now validates the pre-earnings breakdown. I always said you take a pre-earnings breakdown with a grain of salt, but also on the flip side, the charts were clearly bearish. Now you're there. It's at the 50-day. But let's look at the rest of them. Let me grab the earnings, those that reported today. Okay, so that's JP Morgan. I'll look at BlackRock, Wells Fargo, Citi, and Progressive. In fact, let me drag this to another monitor. Okay, so JP Morgan, as you can see on this chart, I haven't fine-tuned it. I haven't marked up in a while, maybe a little hiccup there, but you can see my first stop. Other than, look, they're going to, algos tend to buy moving averages like the 50, and which we're at right now. And but either way, where we're going to be tomorrow, I can't tell you where the stock is going before it goes to any new highs. At minimum, I think that 173.60, and quite likely quite a bit more. Now, remember, we don't have the kind of those all-in sell signals on the break of QQQ 433 yet. I'm going to get to Apple in a second, but so we'll watch this. We'll see what the market does. They gobble it up, and at this point in time, if you are interested in shorting the financial, shorting JP Morgan, or even if you're a bull, and which keep seeing the comments, people think the market's going up for some reason. It's been going down for at least since the post-Fed pop, but you have a gap to be backfilled right there. That would be an objective short entry, and if you're bullish, you probably at very least want to wait to that. You could buy the 50. Again, it's early. This thing just broke down, so to talk about the bullish case, it's not even worth it right now. I'm just giving you levels to watch that would kind of undo this. But that's about 194, and then you'll have a downtrend line forming at some point. You may go and back test those, and that would be, again, an objective short. It would also be, even if you don't want to trade JP Morgan, kind of incorporate into your market analysis. Let's just say 3 weeks from now, we're still in the staying trading range that we've been in for the last couple months, and we're back to the top of the range. And you see JP Morgan rally up to that level. Like I said, you had intersecting downtrend line resistance plus a gap right there, and then that would be an objective short entry, just like it was yesterday. And when I said probably very few, if any, listening to my voice would take it. We hit QQQ, hit the downtrend line. Mentioned that's an objective entry. So a little snide comment, do the opposite, and a lot of likes, but that's do the opposite. If you didn't, if you did the opposite when we shorted the post-Fed meeting, you went all the way down to the bottom of the range in pre-market, and that's where we hit the target. If you, what'd you do? You buy a rally into downtrend line resistance, like I said in yesterday's video. It's TA 101, trading 101. There's no guarantee which way this range will break. You have had my thoughts throughout it. But what I can guarantee, and I did yesterday, that's an objective short entry. But again, I know the most won't want to take it because we're going up, just like nobody wants to go long when we're going down. And I'm speaking metaphorically, guys, not in generally, just kind of to the masses of mindset. It's psychology 101. Most people want to buy something going up, but remember, one of my overriding factors lately has been this. And I'm going to speak on this. This is IEF. I'll get back to the other banks in a second. We're well into the orange zone, so nothing's changed. I haven't wavered on that. This is an area where, especially what's going on, short rallies into resistance. The fact that IEF is actually up today, and you can call this, opinion. You can call it what you want, but it's my interpretation. This is that flight to safety. You're seeing the banks down big, especially the biggest, most important bank by far, JP Morgan. You're seeing, the markets across the board. I'm sorry, tech and everything. So I even turned on CNBC this morning just to make sure I didn't miss anything, and they confirmed there's no reason. This is a flight to safety rally. They were talking about that, and that confirms because you have the equity markets down, no other reason. Anywho, so take it for what it's worth. So therefore, first of all and foremost, we're still well into the orange zone, still in the midpoint of the orange zone after just making new lows into it yesterday. And the fact that we're up today, again, one day at a time, this could change. But as of right now, this is clearly a flight to safety bid on IEF. So therefore, it's a little less significant. We also took out by a hair this PPO divergence. Remember, we had divergence forming there up to this point right there, and until recently, we still have the RSI divergence. And remember, TLT, I told you yesterday, hit the top of my second target zone from way back when. So this is a reflexive bounce. This was an area of short you could have covered. Let's mention yesterday, top of the zone. If bullish and long, you can go long, even if it's just a counter trend bounce. In a downtrend. T2 was kind of the final zone. This is still a potential. I don't know, and I really don't think we're going to get here soon. Ultimately, yes, but if the market, again, it's all about 433 on QQQ and that trading range and the other levels on the FANGs and the recent lows on NVDA, that if they break, we're going to see most likely a flight to safety bid into Treasuries. We're certainly seeing it in gold recently. So, all right, back to the earnings, and then I'll move on to a couple other things and keep this a short video like the last one I got out to you last night. Okay, the other ones where we know what JP Morgan did. I showed you where I think it's going. It's got plenty of room to have a little, let the dip buyers step in today and still, let me just speak to that one last time. Because again, the importance of JP Morgan, I can sit here and talk 20 minutes about this one and give the rest each 30 seconds. This is the most important one. So my point is that being that, you already broke down, this is additional validation, an impulsive move following a breakdown. There's plenty of room for the dip buyers to come in and not change the technical outlook or posture. That would be a rally from here about 4%. It would take us back to intersecting resistance levels, that price resistance right there at about 193.90. 193.90, call it 194. It was already price support before today's gap. You can see this little trading range here, and we gap down below it. And then you have the downtrend line as well. So enough said there. It further reinforces, the fact that the banking, the financials are rolling over, and among other sectors. We're seeing one after another. And again, there's just one group of stocks that continue to hold up. In fact, they're even seeing flight to safety bids. I'll get to Apple in a second. I already talked on that yesterday. It was at great support. Took out a trend line. That's just a technical. It looks like a short covering rally. The same thing I said within the last week. It's due for one soon. And again, I missed that, not having that price alert set on that yesterday or not watching at the time. But again, it'll probably be like I gave you yesterday, short, 3% more upside from where we closed yesterday. Here's BlackRock, also reported down 1%. The biggest asset manager. We got Wells Fargo. That one is actually green today. Like I said, that one I could maybe see a little more upside, but I certainly wouldn't go long. Either way, it had a divergent high already. It's rolling off that. Maybe one more pop, maybe not. Probably not if the financials continue to sell off. If they come in and step in and buy up JP Morgan, then yeah, you can maybe get a little more higher. Citigroup also reported pre-breakdown, boom, here's another great example. But again, I know most won't want to do it. If you're looking to short, that is a very objective short entry. I had that resistance level at 62 there already. Beautiful, like I referred to it yesterday, bearish rising wedge, clean up trend line. We had the sell signal 1 on that first break, then sell signal 2 pre-earnings. Now we broke down, we back tested this morning. We hit, you can see at the highs, and we're rejected. This is a red candle. You can see that means we're at the bottom of it. So they rallied it up right after the open, and then boom, dumping it right now. This is what the institutions, this is what the sellers are doing. So dip buyers gobbled up the dip, and now it's being sold into pretty good. So that's we had Progressive. These are again the ones that reported this morning. Progressive breakdown, back test right now, or close to a back test. Objective short entry, STT, State Street down as well. So that's pretty much just about all of them. Progressive's an insurance company, by the way, not a bank. And those also, that would be the sector the one sector I wouldn't, property and casualty. They've gotten such huge price increases in the last couple of years. They went and ran with this inflation thing, and then some of the wildfires out west, Hurricane Ian down here. And they got to be flush now with these huge increases. So again, so Progressive's kind of, remember, it's not a bank. So we're looking at the banks here and the other financials like BlackRock, asset managers. All right, all right, I already covered IEF. Let's quickly cover Apple and big tech. So Apple used to be, for many, many years, the most important one. And again, was it massive support? That was that same support level. Covered it quite a bit yesterday. Told you there's that 180 level. We could certainly see it carry up there. A lot of momentum, a lot of bulls probably buying it. And again, there was the break. That was the first trend line right there. That was the one that got taken out yesterday. And I gave you a second one we're out. We went right through it. And there's that likely endpoint for this rally. And we'll see if it gets faded. And then NVIDIA, remember, has been dancing on this 840 level. Created that back on March 21st. And we've been dancing on it. A couple days there, still above it. And unless that goes, tech's not going to roll over it's significantly. But that's a big level. And then where we go from there. And then, of course, same thing. QQQ remains in that trading range. Bounce, bounce, bounce. The downtrend line, the near-term downtrend, still intact for now because we got rejected off that and below that previous reaction high there. And we'll see where we go from here. Today's Friday. Like I said, with the financials breaking down, I told you yesterday too, it was all tech, and it wasn't just all tech, it was all Apple. Again, the other things went up. Apple will bring other things up, but watching the charts, doing this a long time, and I told you I looked and went over this. The majority, 6 of the 11 sectors were red yesterday, and 2 of the 5 in the S&P that were green were only up 0.1%. So the rally was all tech yesterday, and I'm seeing a continued trend. A lot of sectors and individual stocks breaking down, and fewer concentration of fewer big names. So for those who still here, listen to my voice, I still maintain that when 433 goes, we're looking at a most likely a pretty powerful start of a big drop. Minimum targets I gave you on the daily chart, swing targets will probably come back down to the 200 days before the buyers step in. With a significant, bounce, and who knows, we could even shoot down through there. There's a lot of hot air in this market. I'll comment on that if and when we get the sell signal. We still keep bouncing on the bottom of the recent trading range. But let me cover this as well. Didn't cover it yesterday, but I've been covering it quite a bit lately, including earlier this week. And I used the words that the VIX earlier this week is ready to let loose once it takes out this 17-ish resistance. And we're there right now. This chart, this program, I have live charts on other monitors. This one, whatever, they delay it on TC2000. But like I said, that's where, I've got pretty decent position. And this is where I'll deploy some dry powder. If you want to add, if you don't trade futures, I use VIX futures. I've got both the current month and next month. That's the Mays and the Aprils. April's going to roll. They're already starting to roll. But if we can get a big move up today, there might be a little pop. The shorter term futures tend to move faster, obviously, because they're about to expire. But if you want to look at, which I've covered, there's some ETFs out there. You'll have to look it up. I'm more of a futures guy, but if it's ETN, you most likely get those annoying tax reporting forms where the ETFs. You'd probably want to, you might want to check the website. So you've got the midterm and short-term futures. And so if the VIX does let loose, watch the VIX index, watch for that level I just showed you. This could go. And you want to play it safe because you can, the VIX is a widowmaker. You got to hit and run. This more than anything, you have to be precise on your entries. and not get in and hold it like a swing position. Like I said, I've had swing shorts on QQQ for over a month now, and they're not going down right to where I average cost, but that's because QQQ has been going sideways. But the VIX doesn't work that way. The VIX it's particularly those ETNs. They're prone to just decay. They have expenses. They have to roll, and so you can get in early on a index short when the stock market or anything you're trading is topping out, but the VIX will usually, you want to be more precise. And that means, again, what does that mean? 433. You want your probability high? Well, you've got VIX right now at resistance. You've got another rejection. You have a clear, as I've been highlighting for a while, a clear near-term downtrend in QQQ, unmistakable, validated by this impulsive rejection off the last rally to the downtrend line, and a rejection prior to that previous high. And now you just need to go down and break it. And I said it last time when we shorted here that I thought we'd probably go there and have little, if any, reaction, go on through. If I thought that then, I think it even more now. Why? These ranges don't go on forever. And why also? Well, financials. I just made a case now that the financials used to be, one of the biggest sectors. That was everything back in the financial crisis. Tech's kind of over the years grown bigger and bigger. But the financials, don't get me wrong, they're probably, at the end of the day, they don't have the mathematical weighting on the indexes, but the importance of the economy cannot be underestimated. That's the most important thing. When the banking system has problems, when they're not making loans, when they're not profitable, the economy is not in good shape. So you need your banking sector in good shape. And either way, it's not cratering right now, but like I said, clear sell signals. They already broke down pre-earnings, and we had confirmation today. So I don't want to beat a dead horse, but I want to impress upon the importance of that. So there it is. VIX looking good, ready to pop. Hasn't done it yet, but that's that level right there. We've been walking up in an uptrend. We had that post FOMC whipsaw, I called it. And if you didn't, take anything else, I think you learned a valuable lesson here. I said, don't read into that too much. You're going to get, usually a sharp move in either direction. It's quite often not the one that lasts. And so that obviously, for VIX traders, it would have, stopped a lot out and, got you even more bullish. But then, boom, we reverse right back up. And as I often say, fewer things in investing and trading are more bullish than a failed breakdown, because for that reason, longs capitulate, they stop out. Shorts tend to pile in. People will, short the VIX. It's a big trade, actually, short vol. And boom, right back up to that same key level. Remember, we already broke. This was a key level, too. We had that triangle there, 1573. That one already broke, and we've just been consolidating. So this, to me, indicates a very decent, elevated chance of, we'll call it a market crash next week, or a big, big down. And it's going to be contingent on two things. Again, the VIX, like I said, is looks like it's ready to let loose. And what's going to be that catalyst? It'll be the two things I told you. You want to keep just two things on your list? Well, I'd like to see the breakout in Apple fail. I think that's, as I told you yesterday, the most likely scenario. They're going to buy it. It's a bear market rally. Apple's been, or at least, it's been in a downtrend, peaked a while ago. I would like to see that happen. But most importantly, NVDA break that support I gave you, 840, and then QQQ under 433. So that's kind of keeping it simple. There's other variables. I'll watch bonds. Continue to watch crude oil. Crude oil is unrelenting. Just keeps going up and up and up. And make no mistake about it, as I've been saying repeatedly, and now you're probably hearing elsewhere. Well, you have to be if you're following the news. Remember, we went from 6 rate cuts down to 3. Now the question is not if it was. The question was, when are we going to start cutting? Now, are we going to start cutting? And, it's funny. Last night I was reading the headlines before I went to bed, pulled my phone out, just skimming, Barron's or one of the sources, a journal. And it was buried way down. The headline that Iran is likely to attack Israel, imminent attack in the next couple of days. And that wasn't like a front page headline. Again, they've, rhetoric, and maybe it doesn't happen. But my God, if you see, and to me that should have been front page headline. I have we'll see, and if it does, guys, and this happens, all I'm trying to do is speak to the markets here and what could happen to crude oil, and that's a red zone for a reason. And like I told you the other day, there's a reaction high there, so pretty much the red zone box. I'm going to do it now because I mentioned it in the video. It should be really with the top of that previous reaction high right there. And so I'm going to move the line up as well, and that's it. So there's your red zone right there, which we're kind of tapping on now. And I say that because we kind of hit the top of it, pull back a little. So there it is. Crude continues to put pressure on interest rates, inflation expectations. Again, it's the one thing of everything to watch, because you can look at it in real time, unlike the housing market, which don't even get me started on that. I watch those trends very closely. Days on market, number of listings coming on board, the 30-year mortgage rate just crossing back above 7% again. I'm not going to even get into that right now, but just remember that's the two pillars of wealth, the two pillars that support consumer confidence, and it's a vicious cycle. The stock market as well are housing prices and stock market. Those that they're in this country and in this world, I hate to sound crass, there's the haves and haves not. The haves are what are driving the stock market. The poor aren't pushing in their 401k, moving into all equities. They're not chasing NVDA and meme stocks and buying the dip on Apple. They're just trying to get by. So it's those that have resources, that own a home, and those are the ones that have money and put money into the stock market and pull money out. So and then when the housing market comes down, and the trend has been showing that, then that will finally most likely. And that's also, I didn't listen to Jamie Dimon's comments. I did hear what he said the other day. You probably heard that, his outlook about we could see 8% rates and all this stuff. It wasn't a very rosy outlook, and but I don't know what JP Morgan said today. But again, their stock says enough. That's all that matters. It's not it's really not important what Dimon said. It's what the market's doing to JP Morgan stock. So that's it. Those are the big things. Like I said, the banks, everything else, continue to roll over. We have right now, looking at the S&P 500. Remember yesterday, the majority of sectors were negative. The 5 that were positive, 2 were basically flat. It was all tech. Today, tech's down 1.2%. Everything else is red except energy and utilities. Those are the only sectors in the S&P that are green as I speak. I'm looking at another monitor, my watch list. And of those two, guess what it is? XLE, which is energy, and XLU, utilities. Those are both. Well, utilities is a defensive sector where institutions will move money when they want to take it out of growth stocks. Smart money, that is. And then energy is the one sector you don't want going up right now, because that's this, and it's inflationary. So, all right, guys, I'm just kind of saying the same thing's over, but that's what we're looking at. Still seeing Treasuries holding up. Obvious flight to safety bid. And so the only other thing to watch for, other than I mentioned, again, watch for this breakout to get sold into. That would be just, to me, a knife through. There was a lot of volume. Yes, and again, it was technically induced. Wouldn't surprise me if the folks that are in charge of Apple's buyback programs kind of strategically or tactically timed to chase that breakout. Again, it was a nice technical setup, but to me, this stock, again, let me just be clear. Now, anything's possible, of course. I'm not here to tell you that. That's a given. I talk in probabilities, and this is. There's no mistaking the fact Apple has been in a downtrend. It peaked here, so you can call that what you want. That's a sideways trend. It's in a larger sideways trend, but that's the sideways trend, but also a near-term downtrend. And so this is a counter-trend rally. And counter-trend rallies, and as I mentioned, PPO is in bearish territory. This will be, in my opinion, a knife through the bull's hearts if it fails. I've also, as yesterday, predicted this breakout will fail. And by failing, again, there's no different. This 166.61 is the same exact level that I was added back here and said that needs to go. as well as those other purple levels on the Mag 7. And not only did it not go, it was successfully defended, and then we're back to it again. And so that's it. So this time I think I already have a price alert, but then I'm going to set an alert. And then it's just kind of, I'm telling you this because it may not happen. This may be it. That may be the end of the correction. And if it does and you're bullish, buy, you can buy, wait for a break above 180. That's where, I think this thing's likely to be capped if it gets that far. I should mention too, that Apple loves the 200-day moving averages. It always has. I've been trading this stock for years. And when you're in a bull trend, it acts as support. Sometimes you'll overshoot it for a day or two, but these are the 200 simple and exponential support. In a bull trend, you buy pullbacks to the 200, right? In a bear trend, when you take it out, and this chart can only go back so far. If you go back long enough, and you can do it on a weekly, go back as long as you want. Look at the 40 period moving averages on the weekly, and it tells you in a bull trend, buy pullbacks to the 200. In a bear trend, once you break below it, like you did back here, like you did back in 2007, 2008, the trend is bearish. And quite often in a bear trend, when you test it, sometimes you'll briefly take it out, but boom, look at this period here. You can see that in here. Let me go back to the daily chart and you can see it nice and clean. There it was. So we took out the 200s there. Had a little, you got to give it a little flexibility sometimes. Like I said, back here we went long. I acknowledge they took out the 200s, but we also were at that purple support level and everything else. That's my analysis is never, especially on these Mag 7 or formerly Mag 7, it's never on one. I take it collectively. You need to see the majority breaking support. So we had all the rest of them above or testing their 200s on Apple. So that's when you kind of give it a little room. Anyway, you can see that once we took it out, it fell back below. Boom, 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 boom. Every rally back to this was the 200 exponential. We got rejected. It was an objective short entry add-on. If you were playing long bounces, sell there. But then you took that back the 200s there. And once you took the 200s back, you successfully back tested several times and then off to the races. Came back down. They bought the 200 exponential a few times there. Then it went. Then they bought the 200 simple. That's why I have them both. Then they bought the 200 simple again, 200 simple, 200 exponential, exponential for about a week. Boom, it broke. Back test rally to it. That might have hit it in pre-market if I remember right, but either way, close enough. And then boom, look where you hit today. So that's it, guys. Take it for what it's worth. If it goes up a little more, you've got the 200 simple. The exponentials tends to, lately it's been really the one kind of capping the majority of the rallies. But again, that's a bounce target range. And if it does much more than that, then that's going to be bullish. There's no other way to spin it. So we'll see. But right now, just like yesterday was a rally back into the downtrend line on QQQ, an objective short entry. This is or was today at the 200, an objective short entry in Apple, coupled with the fact, that this is likely to be a false breakout. All right, I'm going to get the video out to you. It's still relatively short, 28 minutes, just looking at financials and the big tech stocks that do matter. Apple, again, is still not, even though it's no longer magnificent anything, it's still, I think, it's still an important stock in the market and psychologically as well. I'm going to wrap the video up here. We'll most certainly see where we end the day. The VIX, keep an eye on, the S&P 500, because that's really what the VIX is based off of, more so than the NASDAQ. But the VIX just has more liquidity. That's why I'll typically trade the VIX over the VXN, which is the NASDAQ Volatility Index. There's the S&P 500 right there. And, you've got the same key support levels. You have a recent, I'm going to add a line right here, because if you look closely for the last few days, this has been coinciding with the bottom of support on QQQ. This is right now about 512.70, seems to be an important level for the S&P. So the bulls, same story. It's in a trading range. And until we make a definitive break up or down, that's the story. Bulls aren't making money, bears aren't making money unless you're trading actively, swinging these little rips and dips, or you're focusing on the most bullish sectors, stocks, and bearish stocks, you know, being selectively long and short different things, because there are a lot of things rolling over, and that tends to what happened. It tends to happen, especially on a market top. And let's not forget, volatility has been ticking up. We've been in this trading range, and you can see I'm showing you the VIX going up, and the market never crashes or has a big move from record low VIX. It always works its way up like it's doing now, and then it tends to break support and really run like it did, you know, back here when it took out that support, like it did, you know, on all these other rips. You know, you put in a divergent low, you start to zigzag higher, and then at some point the VIX just suddenly explodes higher, and those explosions usually occur with a breakdown of support in the stock market, and then a move down in the market. All right, I'm going to wrap it up here because this is just really focusing on the banks and tech and the market and the VIX, of course, which is part of the market in my opinion. And then I'll do another video on the rest of the commodities. I'll do an update on natural gas, wheat, corn, crude oil, everything else. I kind of touched on crude in here. I'll cover that in another video later today, as well as any sectors or stocks that stand out. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.